Michael, perhaps we start there, and thanks for joining us this morning. Perhaps we start there with where the opportunities lie, especially as food inflation has been on the top of mind for both investors and for consumers right now.
Well, first, thanks for having me this morning. Number one, we think that a moderation in some of the inflationary pressures that have occurred over the last couple of years will allow consumers to spend more money on discretionary goods, things like apparel, home-related products, sporting goods. And that's important for a lot of retailers because they make better margins on those discretionary goods. Number two, with that being said, it is going to be a volatile year for the retail sector, both because of all the well-documented macro pressures, and this is going to be an election year. And it's going to be an election year that's likely to be very polarizing for at least half of the country, probably most of the country. This is also going to mean it's more difficult and expensive for consumer companies to talk with their customers because of a rise in media rates. So our best advice is to remain vigilant and disciplined when approaching investing in the hardline, broadline, and food retail sector this year.
All right, Michael, when it comes to some of the top plays or what investors need to keep in mind in terms of what this all means for positioning, what this all means for companies that maybe are in a better position to benefit from some of these trends that we are seeing, what are some of the top picks within the sector, and what do you think sets them apart from some of their rivals out there?
So number one, we like Target. Target has experienced a turbulent couple of years, but we think it's experiencing momentum that will drive both sales and profitability to improve in 2024. Some of the issues that it's faced are being over-indexed to the categories that are weak, and we believe that will become less of an issue this year as those categories like small appliances, consumer electronics, those start to stabilize and improve. Plus, its margins are well below where they've been in prior years, meaning it's got an opportunity to improve its profitability from here. Another name that we like a lot is Dollar Tree. Dollar Tree runs both the namesake brand as well as the Family Dollar business. Those businesses have been adversely impacted from a very tight labor market as it's been more difficult to attract and retain workers in those stores. We think as the labor market starts to experience some easing, that would actually be a positive for the dollar stores like Dollar Tree, not only because of its ability to better attract and retain workers, but also consumers will have to stretch their budgets a little bit more.
Yeah.
So those are two ideas that we put at the top of your viewers' list of names to own within the retail sector this year.
And I guess Dollar Tree caught our attention in our meetings because in our, of course, recollection of the most recent earnings period, they basically missed on some of the expectations there, plus the outlook came into question. So all of that considered, what is the, perhaps, if there's a technical way to look at Dollar Tree, where is there still strength beyond just the consumer, and what type of mix do they need to then kind of rotate into the store in order to maintain that consumer that might be coming in because, to your point, there is more of a distress on the amount that they're spending?
So the issue that Dollar Tree contended with most recently was, number one, the mix to consumable items away from discretionary goods, and that creates a margin drag. And the other issue is shrink, the unexplained loss of inventory. We think both of those issues will improve in 2024. In addition, Dollar Tree has been implementing a variety of initiatives that will drive growth on top of that. Things like raising the shelf heights in its stores so it can carry more products, adding more multi-price point items in the namesake brand that drive traffic to those stores. So the combination of less pressure from those factors that were weighing on the business last year, along with better results from some of the initiatives it's putting in place, will drive Dollar Tree shares higher this year.
Michael, just lastly, while we have you, how big of an overhang for the food industry and food retail specifically, how much of an overhang is there driven by Ozempic and other weight loss GLP-1s?
So the verdict is still out on the long-term ramifications of anti-obesity medications on the consumption of food in the United States. Obviously, for those who are on it, that has a negative impact on their consumption of calories. With that being said, if you one way to look at it is that maybe 30 million people will be on a anti-obesity medication in the coming years. That's about 10% of the U.S. population. Perhaps those folks reduce their calorie consumption by 20%. So that's a 200 basis point hit to calorie consumption. In theory, that will happen over a multi-year period. So the point here is that while that will be a headwind, that will be a manageable headwind for the industry. Plus, we think if indeed it's more intense than what we are expecting, that would probably lead to some consolidation, which would create opportunity for the large, well-positioned players to gain share within the food retail space.
All right, something we will watch out for here in the months and years ahead. All right, Michael Lasser, always great to have you. UBS, U.S. Hardline, Broadline, and food retail analyst. Thanks so much, Michael.